All right.
You got Cat Cole lined up for the inaugural show. That is
There we
impressive.
go. Oh, this is fantastic. Everyone, welcome, welcome. We've got Kate there with her little phone symbol. She is dialing in Bert, the legend, our special guest who's going to be joining us. Welcome, everyone, as we get the room set. This is the official launch of Investing Workshop Club with Andy. And you're going to hear so much about these folks and a regular series called The Investor Studio by Wealthfront, where Andy and his team welcome icons and legends of investing and actually bring world-class investment experience, perspective, and advice to the platform. So Andy, first, welcome to Clubhouse. While we get Bert up here, I'm going to do official intros in just a minute, but welcome.
Thank you very much for having me. It's exciting to host a new show.
And we have Paul up here. Paul, I know you and Andy know each other, and you've built Clubhouse for so many use cases and purposes, from entertainment to information and education, and certainly giving people access to such world-class counsel perspective advice is one of the many, many benefits of Clubhouse. But would love to toss it over to you to welcome Andy and connect.
Oh man, yeah. Andy was my professor in business school, and I've learned a ton from Andy, and was so excited to see him on the platform. And um, I just I don't even know what I could say about this, but but this is like it's exactly the type of use case that we wanted to enable. And like I'll tell you, just from having had Andy as a professor, people who are listening to this are in for a treat because he was everyone's favorite professor at the school, and we just I'm just really grateful to have learned from him and to have helped build something that will allow other people to experience the same thing. So I don't want to take over the stage or anything like that. I was just so excited for this one, and just wanted to officially say welcome and thank you so much for being here and to provide any tech support as needed. So, so I'll be in the audience, so call me up anytime you like.
Well, Paul, it
We're
means
going
a
to
heck of a
have.
lot to me that you would come and join our first episode, and I'm so excited for you and what you've
Can you
created with this
hear me on the
platform.
iPad?
We
Yes.
can,
Yes,
Bert, loud and
yes, you
clear.
can.
Okay, I'm going to hang up the phone then if I'm on. Okay?
Okay.
Perfect.
Okay,
See, I
now
told you, tech
are
support. That's
we
what I'm here for.
are we good?
We're good.
Well, we're going through all the introductions, Bert, and
That's
then I
right.
will kick off with questions for you in just a moment.
All right,
Okay.
I'm gonna hop back down. But call me up
Hopefully
if you
this
need
will
anything.
just keep on and we're in.
All
Well,
right.
assuming that Paul's engineers have designed a good system, we're in good shape.
Okay.
The only thing I'm going to say before I jump down to the audience is if anyone here isn't following Investing Workshop, tap
Right.
on Investing Workshop at the top left of the screen here and hit follow. That is it.
That's right. All
Back to
right.
the audience for me.
Thank you so much, Paul. And we have such a great room for you all today, a power packed hour. So we're going to get right to it and officially kick off. So, this is the official club launch of Investing Workshop. Top the greenhouse at the top. Follow this club for all kinds of amazing content brought to you by Wealthfront and their amazing network. And we are joined today by Andy, who is co founder and CEO of Wealthfront, co founder and retired partner of Benchmark Capital. I mean, if you are in the venture world, this is a name and a career and a legacy that you're incredibly familiar with. And Andy's also chair of the University of Pennsylvania's Endowment Investment Committee. And so definitely has his finger on the pulse of where money goes and how to think about it, and has built a world-class platform in Wealthfront. And I'm personally a big fan and so excited to hear more about his perspective. And we're also joined by Bert, emeritus professor of economics at Princeton, author of A Random Walk Down Wall Street, and literally the father of passive investing. And I'm just so excited. And Bert, we want to welcome you to Clubhouse. If you get comfortable with the app, when you're done talking, you can hit the little microphone button at the bottom right, and then when you're ready to talk again, you can hit it. That will mute and unmute you. Otherwise, we'll just hear whatever background noise is going on while you're interviewing with Andy, and that's okay. But just want to make sure you know about that feature. And so, with that, we've got some other guests up here, Kate and Brianna with Wealthfront, and Jacques Philippe with Ozone X VC. We'll have Noah Lichtenstein joining us as well in a bit, and they'll be chiming in with questions for everyone in the audience. If you have questions for Andy or Bert, type them in your bio, raise your hand. I'll be scanning the hand raise queue all throughout, and that will allow me to know what's on your minds. And then as we get to the end, we'll be weaving in more audience questions, and if something's really burning, we've got a great back channel and we can talk about your questions and weave them into the conversation. So don't hesitate to ask if you've got a question, giving the amazing insight that these gentlemen are going to bring us. And so, Andy, with that, I'm going to pass it over to you.
Thank you very much, Kat, and thank you for helping us put all of this together. So welcome everyone to the inaugural edition of the Investors Studio. We've tried to model this on the Actors Studio. So I'm playing James Lipton today, and Bert is playing the famous actor. Every week we're going to have someone who has had a very significant impact on the investment business. I'll be interviewing them along with other people on stage, and we want to make sure to make time for people from the audience to ask questions, something that is very seldom possible with the people that we have attracted to our show. As many people know, Bert is also the Chief Investment Officer of Wealthfront, so I just wanted to make sure everybody understood that. And with that, let me get right into it. So Bert, welcome. My first question for you is, what first sparked your interest in investing?
Well, when I was a kid, I enjoyed numbers. I would look at these pages in the newspaper, and at that point, the newspaper would have the prices of all the stocks on the New York Stock Exchange. And I knew as a kid the price of General Motors stock just as well as I knew Ted Williams' batting average. I grew up in Boston, so I was a big Ted Williams fan. I didn't have any money to invest, and just had a kind of love of numbers. And I would follow stocks just for the intellectual interest, just as well as I followed the Boston Red Sox, who at the time would be always beaten by the New York Yankees.
Well, that's most of the time, Bert.
And that was most of the time
Well,
then. That was the time then.
well, Bert and I get along despite the fact that I grew up in New Jersey and I have always been a Yankees fan. So despite that, we have really enjoyed working together. Well, most people don't realize you actually started your career on Wall Street. What specifically did you do?
I did start my career on Wall Street, and I was basically an investment banker at the firm of Smith Barney. Smith Barney is now a part of Morgan Stanley. They were merged some time ago. But I was an investment banker for most of the time there, except for about a 6 month period where I had a very serious knee injury, and I couldn't travel as an investment banker. They had to find something to do with me, and they made me an over the counter trader because I had to go to the Beekman Downtown Hospital near Wall Street for physiotherapy early in the morning and late in the afternoon. So, what could I do where I couldn't really move around much? I was an over the counter trader. We didn't have computers then, but we had banks of telephones, and I did get a feeling both of investment banking and of trading, and I was also very close to all of the research and the money management people in Wall Street. So as someone with an intellectual interest, I was very much steeped in how Wall Street operated.
Well, Bert, I don't know very many people in trading who pursue a PhD. What led you to make that change?
Well, here is the funny thing about my career. When I was in college, I was a pretty good economics student, and I was encouraged by my advisors and by some senior people in the department saying, you know, you've got a flair for economics. You really need to get a PhD in economics and pursue a career as an economics researcher. And I would have none of that because I grew up in a tenement house in a very poor section of Boston. And I decided I did not want to be poor all my life. And so, despite the urging and the interest that I had in economics, I decided no, I wanted to make some money. I didn't want to be poor. I wanted to go to Wall Street. And so, what really happened was when I was then in Wall Street, made a little money, decided, okay, I was not going to be poor all my life. I still had this urge to do something about economics. I still had the economic uh, curiosity. I still had an abounding interest in financial markets. And so I decided to take a leave of absence from my Wall Street job. I was living in Princeton, New Jersey, commuting into New York, and decided I'd take a leave of absence, get a PhD in economics, and then go back to Wall Street afterwards.
So, how long had you worked on Wall Street, and how long at that point did you expect the PhD to take?
Well, generally the PhD takes a lot of people a number of years. I fortunately did mine in about 2 years.
Two
Uh,
years?
yeah, I was in Wall Street for about 3 years, and then kind of two things happened that really shaped my career. I mean, I always had this issue of not really knowing what I wanted to be when I grew up. I knew I didn't want to be poor, but I always had this attraction to economics and the intellectual life and interest in financial markets. And sort of two things happened at the end of this graduate school training. One, much to my surprise, I was offered a job teaching at Princeton University. And secondly, again, much to my surprise, there had been a big scandal at a major company in New Jersey, the Prudential Insurance Company, where the CEO had been accused of making loans from Prudential to companies that he had a financial interest in. He was then summarily fired, and the state of New Jersey basically decided that Prudential needed some reforming, and you needed to have 6 independent directors of Prudential picked by the Chief Justice of the New Jersey Supreme Court. And this Chief Justice interviewed a number of people. He wanted a financial economist, interviewed me, put me on the board of Prudential Insurance. I then went on the finance committee of Prudential Insurance, got to know a lot of CEOs who then put me on other boards, and I decided, hey, you know what? I can actually have my cake and eat it too. I can actually have a business career. I can actually make some money, which interested me enormously, having grown up poor, and at the same time pursue my intellectual interests in financial economics and remain at Princeton. So The funny thing was that that was what really started this kind of career of not having to decide what I wanted to be. I could be both.
Well, clearly the salary of a professor isn't the same as the salary one earns on Wall Street. So how did you get over that prior issue of being, well, you weren't going to become wealthy as a professor, I would imagine. How did you get over the concern that you were leaving all that money behind?
Well, because I really wasn't. And the reason I really wasn't is, Andy, as I think you know, directors of major U.S. corporations are quite reasonably well paid. And they're well paid not only in salary, which might be double the salary that I made as a professor at Princeton University, but they were also well paid in terms of getting shares of stock. I was just looking today as Prudential went, as they say in Wall Street, above par. It went above $100 a share. And looking at my current portfolio, which includes shares of Prudential that I got as a director, and realizing that, I really wasn't giving up this ability to make considerable amounts of money. And this is true of some other boards I've been in. Fortunately, was on one drug company board that became very, very successful. So the fact of the matter was, I really could have my cake and eat it too. I could make as much money as I really desired, and yet lead the kind of life that I wanted to live in a university.
Wow, Bert, you have been on such an incredible journey. And while you've been answering, so many people have entered the room. So for those who've just entered, welcome to the Investing Workshop Club. You'll see the little greenhouse at the top. Follow it for more legends of investing. I mean, just world-class investors who we are getting access to on Clubhouse. And we're joined today with Andy, co-founder and CEO of Wealthfront, co-founder and retired partner of Benchmark Capital, and chair of the University of Pennsylvania's Endowment Investment Committee. And Bert, emeritus professor of economics at Princeton, author of A Random Walk Down Wall Street, and the creator, literally the father of passive investing. And I think for many months, for those of you who've been on Clubhouse, you've wandered in and out of rooms, people giving investing advice, and then we hear the jokes in the back channel that these folks aren't experts. Be careful what you hear and what you listen to. And wow, is it amazing to have such world-class advice. So if you have a question, type it in your bio and raise your hand. I'll be scanning the hand raise queue. You can also keep an eye out for Andy and Wealthfront to be doing regular rooms. This is a series, a show called The Investor Studio, modeled after the Actor Studio, where Andy will interview and explore important topics with some of his amazing friends in the investing world. And so we have an investor and fellow Clubhouse creator up here, Jacques Philippe. Welcome. So excited to have you up here. And I know you've got a question for Bert, and I know you want to talk about stock picking, but we're going to leave that to the very end because it's a polarizing topic and one that Andy and Bert are going to get into. But would love for you to ask Bert a question.
Sure, happy to. Thanks, Kat. Just happy to be here. Andy, you definitely have not let us down. I feel surrounded by titans of industry, true legends, and just humbled to be here. Thank you.
Well, thank you.
Absolutely. And my question for you, Bert, is so I have a 12-year-old son, and this summer he's really into stock picking. And so a project that he'll be working on is he's going to use some of his own money. Okay. I was about to ask a question for later, as Kat had mentioned. So, you know, what led you to notice that active investing consistently underperforms the market in general? Relative to what had been going on at the time.
Sure.
But
I think two things that really sparked this idea. One was that, as I think I had mentioned earlier, I have always had an intellectual curiosity, and I spent a great deal of time, uh, both while I was an investment banker and a trader. I spent a lot of time with the research people at the firm that I was with and with the money managers. And I frankly became somewhat skeptical that I saw a lot of Wall Street research that was interesting, but when I looked at what actually happened to the stocks, while there might have been, when a research report came out, a little pop in the stock, I didn't find any long run effect that I thought worked. And when I looked at the management of the funds from the people who were doing the managing, I was really struck by the fact that this didn't seem to do any better than the market as a whole. And so I wondered whether the emperor really had any clothes. And that was the sort of thought that I had when I left Wall Street. And then when I became an economist and researcher, all of my research was in financial markets. And so what I did was I put together information about how equity mutual funds did and tried to compare this with the various market indices, such as the Standard and Poor's 500 stock index, and actually wrote papers about this and looked at work that had been done at other universities, such as the University of Chicago and MIT, and realized that, in fact, when you looked at the numbers, that these passive indices were generally doing at least as well, if not better, than the active managers. And so that was really the kind of insight that I had, both from looking at how it was done on the inside at Wall Street and then looking at what the numbers actually showed. And that was what led me to write the book, A Random Walk Down Wall Street, where the thesis was that really the market is so unpredictable. And that's the idea of the random walk, simply that markets are quite unpredictable. And secondly, that passive management actually empirically can be shown to work even better than active management. So it was a kind of combination of the experience and seeing how it was done on the inside, and then looking as a researcher on what the numbers showed.
So, Bert, when did you actually first publish the book, and what was the initial reaction to it?
The book was first published in 1973. In fact, I am now begun to work on the 50th anniversary edition of this
Congratulations.
book. So that was how it was. That was when it was first published. And frankly, Andy, the initial reaction was that this book was the biggest piece of garbage you. I had a review by a market professional in Business Week magazine and said this was the most naive and ridiculous and wrong-headed piece of work you have ever imagined. So the initial reaction was simply terrible. The book suggested that what there ought to be in the world was actual index funds, and they didn't exist. There were the Wells Fargo Bank had an institutional index fund that a couple of institutions invested in, but there was nothing available for the public. And so the idea that this is the way you ought to invest was thought of as being a ridiculous idea. And in fact, 3 years later, when Jack Bogle of the Vanguard Group started the first index fund, I think a lot of people know the story that he was having an IPO, hoping to raise $250 million for what he called the first index fund, the first index investment trust. The investment bankers were able to sell only $11 million of it. It was very, very slow to take off. People thought, again, that the actual index fund was the dumbest idea in the world.
So, Bert, was it your common failure that brought you together? Because I know you worked together for many, many years.
Exactly. Jack then had me on one of the other boards that I was on was the Vanguard board, and Jack and I were really soulmates. And I have enormous respect for Jack. It's one thing for an academic to come up with what seemed to a lot of people a silly idea, but Jack bet his whole company on it. And so you're absolutely right. We were definitely soulmates. And in fact, I used to joke with Jack that I thought for a number of years after the first index fund was formed, that he and I were the only investors in it.
And how many years were you on that Vanguard board?
I was on that Vanguard board for 28 years, and fortunately was on that board to see the idea of indexing prove itself not only as a successful investment strategy, but also as a successful business strategy. Because today, within equity mutual funds, more than half of the billions of dollars invested in equity mutual funds are indexed. And fortunately, the evidence has accumulated that, in fact, it's not, the idea, one of the things that indexing was ridiculed as who wants guaranteed mediocrity? Who wants to be average? We want to be like in Lake Wobegon when all the children are above average. The fact of the matter is, the evidence is that it isn't a mediocre strategy. It isn't an average strategy. It's an above average strategy. And the way we know about this is Standard & Poor's they are now the scorekeeper of how index funds have behaved versus actively managed funds. And they come out each year with what they call the SPIVA report, Standard & Poor's versus active. And what the SPIVA reports show is that every year, about 2/3 of active managers are outperformed by a simple index fund. And the problem is the 1/3 that outperform in one year are not the same as the ones who outperform in the next year. It's like you see this. Kathy Wood had this wonderful outperformance last year, and she's doing terribly this year. This is the way it goes. And when you look out 10 or 20 years, you find only 10% of active managers outperform the index. I'm not saying it's impossible to outperform.
Because there are outliers. There are always
There are
outliers.
outliers, but the problem is once you go active, it's the 90% of the time you'll underperform. And it's almost like looking for a needle in a haystack in terms of long run outperformance. So I say buy the haystack. Even Warren Buffett, who had this wonderful performance, the last 5 or 10 years, he's underperformed the market. So again, I'm not saying it's impossible to outperform, but at least my view is the core of one's portfolio ought to be indexed. If you then want to go active and you want to do something because you think you can outperform, fine. But you're going to have a much safer and excellent investment strategy if the core of your portfolio is indexed. And one of the things that is really very interesting is that even in inefficient markets, the emerging markets are certainly very inefficient. Information isn't immediately reflected in prices. The trading markets are inefficient, but even there, the same kind of thing happens, that most active managers are underperforming the emerging market indices. And so, since I believe in wide diversification, I think you ought to own not only US stocks, but international stocks and emerging market stocks. Even there, indexing isn't a mediocre strategy, it's an above average strategy. And therefore, the core of one's portfolio should be in a diversified group of index funds. And Andy, as you know, one of the reasons why I was so excited to be able to work with a company like Wealthfront that puts together diversified portfolios of index funds is that I know that this is a good thing. It's an optimal thing for the core portfolios for most investors in the world.
Wow, Bert, I was just, back channeling this mind-blowing insight, which I'm sure, you and Andy and the team at Wealthfront have and appreciate deeply. But the fact that two-thirds of these actively managed funds do not outperform index, and then the third that does is a different third, is a
Yeah.
different group each time. And then my scientific brain goes to, okay, well, what is the fraction of them that are the same, and who are those outliers, and what do they do differently? And I'm just fascinated by your global perspective that Wealthfront has, that you both have, around things being not just average, but better than average, and how we all, keep in mind, people in the audience, I know you don't see them, but if you scroll down, there are hundreds and hundreds of people in this room. There have already been thousands who have come in and out and listened to a piece of this at varying points in their investment journey. And I know that you are about to get into a juicy part of this discussion that I am being DM'd about, I'm getting messaged about, which is just where the world is now. But before we do that, I want to welcome up Noah Lichtenstein. Noah, welcome. Special guest, also an investor like Jacques Philippe, creator on Clubhouse, and he's going to be joining our discussion in a bit. And for those who have just joined the room, this is the official launch of the Investing Workshop Club by Wealthfront. Click the little green house, follow it for legends and icons of investing to talk deeply and intimately about their experiences and their perspectives, which are much different than the meme headline clickbait information that we often digest through social media, and one of the beautiful elements of Clubhouse, having these long form discussions. And this is a regular series that Andy is hosting called the Investor Studio by Wealthfront, modeled after the Actor Studio, where Andy's interviewing his amazing friends and network and leaders in this space, and we all get to listen and benefit from that education. If you have a question, put it in your bio and raise your hand. I see a few of you already have some great ones. I'm going to bring some folks up here in a bit as Andy gets through this. Next section that Andy, I have to tell you from my Twitter DMs, people are hotly anticipating. The folks want to know
I
about
knew they
stock
would, but I
picking.
wanted people first to understand Bert's background before we get to
Yes,
that.
absolutely.
So let me actually get right into it. So Bert, every few years I read articles that we're now in a stock picker's market. What's your reaction to these points?
Well, this is, what's sort of so interesting. There is still this idea that indexing is an optimal strategy, is not one that's accepted by a lot of
Even
professionals.
though the peer-reviewed research is incredibly consistent, correct?
Both the peer-reviewed research and the research by companies like Standard and Poor's is so consistent. But every year you hear, and particularly at the beginning of the year, well, last year,
That's true. I always get it in
at the
January.
beginning of the year, last year was fine. The index outperformed, but now we're in a stock picker's market. And it's amazing. I see it every single year. And every single year, uh, the uh, uh, the index continues to outperform. It was, insanity has been defined as boy, you saw the thing didn't work, but you keep refusing to believe that it's true. And of course, the reason that for an active manager that you believe that it isn't true is that look, this is a business, both stock picking, both running a mutual fund and advising people, that is a very lucrative business. The average active mutual fund charges an expense ratio that's close to 100 basis points a year, 1 percentage point a year. Right now, competition has driven the cost of buying a mutual fund down essentially to zero. I mean, the ETFs that do broad-based index funds can be bought at 2 or 3 basis points a year. So basically, indexing costs nothing, and the active manager typically charges close to 1 percentage point a
So
year.
they have to make this case to protect their business because if they don't, that's a really serious loss of profits.
That's exactly right. And therefore, it's not surprising that the difference between the returns of the index fund and the average manager is very well approximated by the difference in their fees. And so, even if you didn't believe me that markets are reasonably efficient, uh, the fact is that if you can get this portfolio at essentially zero cost, you're going to outperform a portfolio that charges you 1% a year. And again, going back to Wealthfront, if you have an investment advisor to put your portfolio together, that investment advisor might charge 1% or even 2% or 3% a year. If you can get this at a place like Wealthfront that does it through software and index funds and charges 1/4 of 1%, you know you're going to get the best advice at the lowest price that you possibly can. So, again, I'm not saying uh, when I tell you that markets are fairly efficient, I'm not saying that doesn't mean the market's always right. The market's usually wrong. In fact, the market's always wrong. The problem is nobody knows for sure whether a price of a stock is too high or too low. And that's the problem that active managers have. It's not that the prices are perfect, they're not perfect. But the fact of the matter is, we know the evidence is so clear that it really is like looking for a needle in a haystack, that you're going to really outperform. Try it if you want, but by God, it's absolutely the optimal strategy to have at least the core of your portfolio in a well diversified set of index funds.
So, Bert, another increasingly common criticism of passive investing, and I see this reprinted every year, is it's going to screw up the market and the economy if it gets much larger, that it's almost Marxist. What do you think of that?
Well, there is a paradox about the idea of efficient markets. I mean, the idea of efficient markets is simply that information gets reflected very quickly into stock prices. And I think that part of it is probably very well supported by the evidence. But what's the paradox is you need some active managers to make sure that the information gets reflected. In other words, if some drug company has developed a new drug for a certain form of cancer, and they announce stage 3 results from their trials, somebody's got to go and act on this to make sure that the information does get reflected in the price. Now, normally the announcement is made after the market closes and the price is already changed when it opens the next day, but there's got to be somebody active to do that. So that's the paradox. And in fact, it may very well be that some hedge fund that actually got news of this and acted before somebody else to drive the price up to where it should be so that it reflects the news. It may be that that person does make some money, but you don't need the amount of active managers that we have now to make that happen. I said that
How much do you
indexing,
need, Bert? I mean,
well,
what percentage of the market needs to be active in order
okay.
for
Well,
pricing
right
to be reasonable?
now, in the mutual fund area, we're talking about indexing being somewhat over half. And what if it was 75%? Would 25% be enough? Sure, it would. Would 80% indexed and 20% active be enough? Would 5% active be enough? Could we ever get to the point where, let's just take the argument that some people use, what if everybody indexed and then information didn't get reflected? In as long as we've got a free market system where somebody can get into the market where information was not reflected, I can't imagine that some hedge fund isn't going to get in and make sure that the information isn't reflected. You know, suppose there's the stage 3 trial, and this is going to, we've actually solved, we can cure pancreatic cancer. And this is announced, and the market doesn't change. Can you imagine a situation where it doesn't change because everybody's indexed? There's going to be somebody with some amount of money that runs into the market and buys that drug company. So I just can't imagine that we're ever going to be in a situation where the market collapses because nobody is acting on information where they see a profit opportunity. I don't think that's going to happen in a capitalist system where people are free to put their money where they want to.
Okay, Noah, do
Yeah.
you have a question for Bert?
Yeah, we've got Noah Lichtenstein,
I,
or founder at Crossover VC. Noah, I know you love this topic of investing. Would love for you to ask a question to Bert.
no, I love it. And I love it because this is a sector of the market that's on the opposite end of the spectrum. So, Bert, thank you so much for taking the time to share your wisdom, and Andy for hosting, and Kat as well for being the master of ceremonies. So, my question then is just so, Bert, do you pick stocks ever? And if you do, what are the exceptions or what's the framework that you use to make those decisions?
Look, there isn't anybody who spends one's entire life working in financial markets that doesn't have something of a gambling instinct. And yes, I buy individual stocks. All my retirement funds are safely indexed. The largest part of my portfolio, the major part of my portfolio is indexed. But yes, I pick individual stocks because it's fun. I go to Las Vegas because it's fun. I go to the blackjack tables because it's fun, not because I expect to beat the house. The house has an advantage, but I enjoy playing. As I indicated earlier, through the boards that I have been on, have holdings of individual companies that I have had for a number of years. And I will sometimes try to pick an individual stock, but I do it well aware that I do this because investing is fun and I can do it with much less risk because I know that my important retirement money is safely invested in a widely diversified set of indexed investments.
Okay, Bert, now we're going to go to questions from the audience. So,
All
Kat,
right. Yeah. So if anyone's got questions, we have a little bit of time for Q&A here with these investment legends. Welcome to the investing workshop. Hit the little greenhouse at the top left of the screen. That's the club where this phenomenal content will be shared regularly here on Clubhouse. Andy is hosting a series called The Investor Studio, where he does what he's doing now and interviews and world-class investors, people who have been thought leaders for quite some time on all topics related to investing. And then we'll have various guests up here exploring these topics. And so, Kobe, you had a great question. We'll go to you. And then once Bert and Andy can jam on that question, then Sean will come over to you. Kobe? Oh, you're on mute, Kobe. He may be in a meeting or a call. Sean, we'll pop over to you, and then I'll come back to Kobe after.
Thank you so much. Thank you, Kat, for the club and the room. And thank you, Andy. I heard your incredibly inspiring conversation with Mark Andreessen the other day. And thank you so much, Bert. Okay, so my question for you, Bert, is if I read your research correctly, it suggests that maybe people should get out of finance and go into business. Is this what your research suggests? And could you elaborate?
No, I don't really think so. I really believe that the entrepreneurial things that have been done have been extremely helpful. If Jack Bogle hadn't started index funds, these wouldn't have been available for individuals. In fact, one of the things that I have been so pleased with in writing my book, the thing that probably pleases me more than anything else is the letters that I get from people who say, I read your book 30 years ago. I followed your advice. I put my retirement funds into index funds. I diversified the way you told me to. I regularly saved and put money into this retirement fund. And I never made a great salary in my life, but now I am retired and I'm enjoying a comfortable retirement. That really makes me feel good. And without the innovation of what started with Vanguard and what's now available from lots of other purveyors, that wouldn't have happened. As I indicated earlier, the reason that I'm so pleased to be a part of Wealthfront is for the people who don't want to do it themselves, who really would like somebody to put together that kind of diversified portfolio. The fact that we've got an innovation from Wealthfront, that we can do it with software and we can do it at minimal expense. I think this is a great benefit for society, and I am sure there will be other innovations in the future. So I'm not saying at all that that means that people should get out of finance, that people should stop innovating. Quite the contrary. This suggests that as we learn more, we can in fact innovate more and we can do better things for the ordinary people who are just trying to save for a particular need that they have, and in particular to enjoy a reasonably comfortable and robust retirement.
Thanks, Bert, so much. Kobe, are you back with us?
I'm back.
All
So
right.
Bert, Andy, Kat, thank you. My original question was around a potential, if there is one, a systemic risk on if more and more people follow this advice, which I agree with. Where do we end up down the road? And I think you sufficiently answered that. And so I guess my next question would be, coming from a world where you always want to beat the guy next to you, is there any advice you can give for someone who struggles with the idea that while the group of purchasers of indices are beating the market broadly, you still want to outperform?
Sure. No, I understand that, but let me first of all just get the first question that you had hinted about the systemic
No,
risk.
I think Bert, because we have limited time, I think you addressed that earlier when we talked about Marxism and index investing. So let's focus on just the second part, and then we have one final question, given that we're running out of
Okay,
time.
sure. No, I understand that, and as I indicated, I sort of feel that myself, and it's really fun to do. So I say, absolutely, go try to do that. If you think that boy, I've got this particular electric vehicle manufacturer and I think this is going to be a winner and it's going to beat the index, that's fine. And you can do it with much less risk if you have the lion's share of your portfolio well diversified in low cost index funds. It almost gives you the feeling and the ability to do precisely that with very much less risk than if you put your whole portfolio into some new innovative idea that didn't work. So it's almost something that enables you to do precisely that. And I understand the motivation, and I think it's absolutely fine to do, but do it on the fringes of a portfolio, not your whole investing outlook.
You know, Bert, one of the really negative sides of day trading or trying to invest in stocks and trade them is the taxes that you incur because they're short-term capital gains. One of the huge benefits of having a diversified portfolio managed by Wealthfront is our tax loss harvesting, which will significantly reduce that tax burden on your individual stock trading. We don't really talk about that very much, but that's the nice thing about marrying this responsible, boring portfolio with trying some individual
No,
investments.
there's no
Okay,
question about that, Andy. The idea of outperformance is often called in Wall Street gaining an alpha. And the only sure alpha I know is to be able to tax loss harvest. Most of the time, when you buy an active fund, you get a 1099 at the end of the year saying you owe so much in taxes. When you tax loss harvest, you get the 1099 at the end of the year saying you've got a tax deduction. And that's the only sure alpha I know of that you can get from investing.
All right, so we have moved from this incredible legacy background of Bert and the school of thought around passive investing and indexes, and then moved into stocks and equities and even touched on day trading and in this moment we're in with memes. And Francesca is up here for our last question, bringing us even further into the future with a topic that is coming up very often on Clubhouse. Francesca.
Thank you so much, Kat and Andy and Bert. Bert, my question is about cryptocurrency and what your thoughts are on the role of investing in cryptocurrency as part of a diversified portfolio.
I do not favor cryptocurrencies in the diversified portfolio mix. First of all, we're talking about Bitcoin going up and down $5,000 in a single day. Nobody knows what the price of Bitcoin should be. I mean, this is actually just pure gambling. And I worry that over the long run, not that I think that cryptocurrencies aren't going to happen, but I think they are going to happen by governments. Governments are not going to allow uh, private enterprises to basically usurp the government's role as the creator of currencies. And something that is mainly used to finance illicit transactions is, I think, not going to be allowed in the long run to prevail. So I think we will have cryptocurrencies. I think they will tend to be government sponsored. I also do not think that the blockchain technology, which is very energy intensive and really is in some sense quite inefficient, is the way that cryptocurrencies are going to prevail in the future. So I think governments are going to do it, and they're going to do it in a way that it can be monitored, because something that is mainly used for transactions, for illicit transactions, is not going to be something in the long run that is allowed to prevail.
I want to remind people that not only is Bert an expert on investing, but Bert actually served on the Council of Economic Advisors in the 1970s. So he has a very broad knowledge of government policy as it relates to economics as well. Well, Bert, I want to thank you so much for joining us today. This was just a wonderful way to kick off the Investor Studio. Next week, our guest is going to be Howard Marks, who is my investment idol. Howard is the co-founder of Oak Tree Capital, the premier distressed debt investor in the world. We're going to interview people who invest in a lot of different things, but I look forward to that conversation as well. Kat, thank you so much for helping us put this show on. I'd like to thank Kate Walk, who helped, Brianna Wilvert, who helped us with this, Noah, Jacques Pierre, and our questioners today, Sean, Francesca, and Kobe. So thank you, everyone, and we look forward to seeing you next week.
Thanks, everyone. Follow the club, follow this series and these folks, and we will see you in the Clubhouse hallway. Thanks, Andy, Bert, and everyone up here. Have a great day.
Thank you.